Hi friends, welcome to Adda 24/7. We are in the Scholar series for BFM. Here we are covering all the important theory, numericals, objective questions, case studies. So follow the series completely till the end and also follow all the parts of the series. Follow it daily. Okay, let's start. First one, RAROC stands for, what is RAROC? Risk Associated Return on Capital. Risk Adjusted Return on Capital. Revenue Adjusted Return on Capital. Risk Associated Reward on Capital. So what is RAROC? Risk Associated Return on Capital. Risk Adjusted Return on Capital. What is it? Is it associated? Is it adjusted or revenue adjusted? Risk again associated reward on capital. Is it a reward? I'll give a few explanations about this. Firstly, before knowing RAROC, you must know what is ROC. So here I'll explain it over here. We are having space over here. ROC. What is ROC? A return on capital. Return on capital. Do you know something about this ROC? What I have invested and what am I getting in returns? That's it. Suppose if I have invested 1 lakh rupees and per year I am getting, let's say, 7,000 rupees from it. So my ROC is what? My ROC is 7%. 7,000 upon 1 lakh into 100. So that is my share. I have invested 1 lakh. Now I'll explain you RAROC. Invested 1 lakh. Invested 1 lakh. Okay. Returns per annum. Now look at this. Per annum. Returns per annum. Per year we call it. Okay. Per year equals to, let me make it 9,000. So what is my ROC then? My ROC equals to 9,000 upon 1 lakh, right, invested into 100. So it is 9%. But what is RAROC then? RAROC means risk adjusted. What is risk adjusted? Suppose, look at it. Suppose if I invest this in some shares and there is a chance that the share might go down. Now to adjust these shares, I have taken some insurance, or I have made some riskier bet. Let's say shares, or I have invested in something else which may go down also. There is the risk of going down. So to adjust that, I have purchased the insurance. Now the cost of that insurance is, let's say, rupees 2,000 insurance I have purchased to safeguard against my investment. Insurance. The cost of this insurance is, let's say, 2,000. Okay. So what is my net returns now? This 2,000 I am giving annually. I am getting annually 9,000. So my RAROC, risk adjusted return on capital, becomes 9 minus 2 minus 2,000 upon 1 lakh. Okay. And that into that 100. So now it becomes 7%. Okay. So that is RAROC. And the full form of this is risk adjusted return on capital. Okay. Got it? There are two separate words. One is RAROC, RAROC. That is RAROC. And second word is similar one, RORAC. These two are separate words. Remember, risk adjusted return on capital and return on risk adjusted capital. These two are separate words. In exam, if they ask you RORAC, then it is return on, see, this wordings are same. Only the order changes. Return on risk adjusted capital and risk adjusted return on capital. Understand this very clearly. Okay. Okay, now shall we move on? Yeah. In the process of risk management, which out of the following is correct order? Means Which is the correct order in risk management? Quantification, identification, control, and mitigation. Now all the sequences are given. You can read this. Read it and tell me, everyone. Yeah. Which one? Which one? Everyone, read it, read it. Identification, quantification, mitigation, control. Identification, quantification, control, mitigation. And last one is this: identification, quanti, and control. So what is the answer? The correct sequence is, okay, what do we do whenever you see any problem? First you identify the problem. So first is identification. So either B or C now. Okay, so A and B are out. So A and D, sorry, A and D are out. This is out and D is out. So first I'll identify the problem. Afterwards what? Now look at this: quantification, mitigation, and control. What is mitigation? Mitigation means minimizing the risk. Minimize. Okay. How will I minimize? Before minimizing, I must know what is the quantity of that risk. Right? When do you minimize any problem? Whenever you know how big that problem is. So quantification is the second step. So quantification is also correct. So identification, quantification. Now mitigation and control. Now do you control first and then mitigate, or do you mitigate first? Mitigate means minimizing and then control. So the correct sequence over here becomes this. First you mitigate, then control. So identification, quantification, mitigation, and control. Okay, this is a sequence always. Now what is mitigation? You will ask me, sir, what is mitigation? Quantification means we know. What is mitigation? Reduction. The same example which I gave you just now about that insurance means I have invested in some riskier project. Let's say riskier, not only shares, because we don't take insurance against shares. We should take actually for large investments. But let's say I have invested in some big factory. The return from that factory is, let's say, as I gave you that example, 9,000 per 1 lakh. Now the insurance for that factory is 2,000. So then that becomes my mitigation part. Okay, got it? Financial risk is the uncertainty that results in, here. Firstly, what is risk? Financial risk. Risk means anything which is uncertain. There are two things to risk always. One is uncertainty, and second point is for risk is, that is given in the answer. Now that's what you have to find out. Uncertainty first, that results in adverse market report of the business, adverse variation of profitability or outright losses, adverse movement of capital of the bank, and all of the above. Now look at this, all of the above. That can also be one answer. Huh? Yeah. Think over it. All of the above can also be one answer. Adverse. So how many of you feel answer is D, all of the above? Let me see in the comment section. How many of you are typing in D? I'll wait for 20 seconds. Let's see. Okay. So let me see how many of you have typed D as an answer. The answer is not D actually. The answer is only related to profit. Okay. So variation in profit or outright losses. This is the answer for this question. That results in outright losses. Here, financial risk has 2 points always. One is uncertainty, and it should result in less income or negative income. Okay, only then we'll consider it as a risk. how much profit am I earning? Suppose if I'm earning 1 lakh rupees as my profit, if my profit decreases from 1 lakh to 70,000, then it's a risk. Or this 1 lakh profit decreases to minus 1 lakh, means losses of 1 lakh, then also it's a risk. If my profit of 1 lakh in any project increases to 2 lakhs, so is it a risk? No, it's not a risk, right? Got it? So the answer is financial risk is the uncertainty that results in adverse variation of profitability and outright losses. A person wants to make an investment of rupees 50,000 in one of the following for 5 years. Out of these, which one should be preferred? Solely on the basis of risk. Solely on the basis of risk. Look at this. If the return is 10% in all the cases. Now, I am having 50,000. I have to invest it for 5 years. Okay, or you are having 50,000, you have to invest it for 5 years. Let's say you are the case, you are the one who is having 50,000, want to invest it for 5 years. All the investments are giving you 10% return. So what will you invest in? FDR issued by NBFC, a bank FDR, a long-term government security. All are equal since the return is same. Very important. Which one will you invest? Let me see. FDR issued by NBFC. I know you all are bankers because being in the bank, you all will always prefer what? Bank. Oh, bank is the safest institution. Bank. Right? NBFC, no, because many of the bankers have unknowingly we have considered NBFCs as our enemies. Oh, these NBFCs are going ahead of us, right? So many of us, no NBFC. Now here your emotions are getting attached to the answer. I don't like NBFCs. I like my bank. Or I don't like my bank. Then also, that can also be the one point. But what is the correct answer as per the risk factor? Which is the safest investment? NBFC, bank FDR or government security? The correct answer is what? Correct. The correct answer is long-term government security. Okay. Long-term government security. Always remember this, because government is always having the sovereign rating. Sovereign in any country. Sovereign rating means 0% rating. 0% risk. All others have risk. But based on the risk percentage or risk factor, we should always invest in government security. Okay, but depends which government it is. Now government security means if you say, sir, if I invest in bonds of Pakistan, then no, Pakistan government security means your own country's government security. That's what is the meaning, not any other countries. Okay, so it depends on the government also. Suppose if American treasury bonds, if somebody wants to invest, many of the institutions in India are investing in US treasury bonds. They are allowed because the rating is sovereign. But if tomorrow Sri Lankan government issues the bonds, will you invest in that? No. You have to check the government's risk also. What is the level of that government? Okay. So specifically talking from the Indian perspective, here we mean Indian government only. So even in Pakistan, okay, understand this. If this question would have been in Sri Lanka or in Pakistan, then also this answer would have been correct. Why? Because for them, their government security is government is sovereign. Okay, you won't invest in them, but many of those persons there can invest, because if government is not secure for them, how can the NBFC and FDR be, bank FDR be secure in that case, right? So that's why a long-term government security will always have the sovereign risk or 0% risk. Okay, got it, everyone? What are the types of government bonds? Tell me, everyone. Government bonds issues bonds in two types. Okay, government, it issues bonds in two types. One is less than 1 year or 364 days. That's a specific answer. 364 days. And second is greater than or equal to 364 In fact, less than or equal to 364 days. This is greater than 364 days. Means greater than 1 year we call it generally. These are called as T-bills. And these are called as dated bonds. Dated. Okay, dated bonds or dated securities bonds. Okay. There is a third category. Means nowadays it has been made. It is less than 91 days. These are called as CMBs. CMB, cash management bills. Okay. So these are the three categories of government bond generally. Okay. Which of the following is correct statement? Lower the risk premium. Lower the risk, higher the risk premium. Lower the risk, higher the risk, lower the risk premium. And the second one, lower the risk, no risk premium. Which of them is correct? Okay, you guys tell me. Suppose if you buy insurance at the age of, let's say 20, 21. Okay. You buy insurance at the age of 21. Or you buy insurance at the age of 45. Okay. Which premium will be higher? This will have low premium insurance. I'll write it insurance over here. Insurance. Same insurance over here. I'm buying insurance at 21 age or 45 age. Which insurance premium will be higher? Of course, this will be higher, right? This high. This will be low. Why? Because lower the risk premium. Why the lower the risk? After the age of 40, the insurance premium increases because the risk of various diseases increases. Okay, so lower the risk premium. Now the answer can be, many of you might be thinking about A or you might be thinking about D also. Lower the risk, no risk premium. So the answer is not no risk premium, it is this A, low risk premium. Because in that case, if no risk premium, then the insurance premium for this person of 21 age should be 0. They should give this insurance at free. Isn't it? No risk premium, right? So that's why it can't be no risk premium, it will be lower risk premium. Okay. Management of risk within a bank is a major concern of top management, senior management, middle management, operational management. Which, yes. Management of risk is a major concern of which management? Top, senior, middle, and operational. Do you know the sequence of this risk management in banking? Then you'll understand. First, top level is what? Board of directors. Afterwards comes what? Who can tell me? Afterwards, below this, it is RMCB, Risk Management Committee to Board. After RMCB, there are 3 committees then. Okay, ALCO. You might have heard this name ALCO many times, right? Then CRMC. And last one is ORMC. Right? This is the sequence. Then below this, there are subgroups or support groups, we call it. Support groups to this. Below this. This is the overall framework. Okay? Support groups to all these 3. So this is the framework. So who is at the top? The main person is what? Board of directors or top management. Okay? So it is, answer is this, top management. Management of risk within a bank is a major concern of top management. Okay? Actually, the correct answer is board of directors, but you have to choose within the given answers. If there would have been the answer of board of directors over here, you would have selected board of directors. Okay? Got it? Clear everyone? Next one. Management of risk begins with mitigation of risk, identification of risk, controlling of risk, and quantification of risk. So it begins with what? Just now I gave you this 4 sequence, we saw it now. It was this. We'll move fast on this. Identification, right? Begins with. Usually the risk management organization in a bank consists of board of directors. Look at this. Same I gave you, right? Board of directors, RMCB, Risk Management Committee to Board, Senior Level Executives Committee, Risk Management Support Group. an operational risk management team. So it consists of what? Risk management organization in bank consists of. So it consists of what? There is something remaining in this, right? There should be options over here. Yeah. Risk management organization in the bank consists of, yes, there is something remaining over here. Yep. It should be like this. See here, the sequence I'll give you. Okay, I'll type this sequence over here for you. Okay. Let me change this option a bit. Okay, I'll give you one sequence over here. Seventh one is, so let me write this A as only 1, 2, 3 and 3 senior management, and fourth is risk management support group. Yes, fourth. And fifth one is operational risk management team. So this fifth, operational risk management team. Yeah, let me write this fifth one also, or let me, yeah, fifth one. And B is what? B I'll make it only 4, these 4. Okay, not fifth one. C I'll make something different. C means only 3 I'll make it. Okay, and D I'll make it only 2. So now you tell me 1, 2, 3, 4, 5. Then B is 1, 2, 3, 4 only. Then this 1, 2, 3, and last one is 1 and 2. So what do you think should be the answer over here? Okay, it should be, again I am seeing the answer all of you are typing is this A, all of the above. No, answer is not all of the above. All of the above is not always the right answer. It can be a trap also. The correct answer is B. Okay, B. Why? Because only up to 4 elements it is considered: board of directors, risk management committee to board, senior level executives committee, and risk management support groups. Now this operational risk management team, when we say, this is a part of 4 only. Risk management support group. Risk management support groups will be of 3 types. One is credit risk management support group, operational risk management support group, and last one will be that market risk management support group. So this operational risk management team or group will be a part of this 4 only. You need not mention it separately. So that's why the answer is B. What? 1, 2, 3 and 4. Okay, so that is the answer. Got it, everyone? That should be the answer. Remember, operational risk management team need not be mentioned separately in this sequence. Just now I gave you this now. See this. ALCO, CRMC, ORMC is a part of the senior level or the support group. Okay. Which of the following has the responsibility for implementation of risk and business policies simultaneously in a consistent manner and decides RMCB, Senior Level Executives Committee and Risk Management Support Groups? Who has the responsibility for implementation of risk? The answer lies in this first line itself, implementation of risk. That's it. There lies the answer. Board of Directors, Risk, RMCB, Senior Level Executives Committee, or RMSB, SGU, you call it. What is the answer? Everyone is typing Board of Directors. No, Board of Directors is not the answer. Why? Implementation, board, see the sequence. Implementation is a job of Senior Level Executive Committee. Executive, what is the meaning of executive? Executive is there for implementation. Manager, senior manager, vice president, all these persons are for implementation. Board of directors will never implement the things. They will see to it that they are implemented. Say this. See, look at this sequence again. Board of directors, RMCB and ALCO CRH. This is a implementation level. This from here. This is a policy making level. Policy making. This is policy making. Okay, and this is implementation part, lower level. Okay, so always remember this implementation. Got it? So everyone got this answer? Risk management, this RMCB and both these A and B are for policy making, and RMCB also sees to it that it is implemented, but it doesn't work personally. Okay, got the answer, everyone? Shall we move on now? Here, yeah. This all remaining things, I think so we did it already. Yeah. Okay. So got it, everyone? Senior level executives committee. Type yes in the comment section if you have understood up till now. Welcome to Adda 24/7. We are in the Scholar series for BFM. Here we are covering important theory, numericals, objective questions, case studies. So watch the series till the end. Also, watch all the parts of the series. Okay, let's start. So let's start. First one, Monte Carlo simulation method. Calculate the changes in the value of the portfolio by using. So Monte Carlo simulation method. Okay. Now before going to the options, first you understand what is Monte Carlo simulation, isn't it? Without knowing anything, it's of no use going somewhere, right? So Monte Carlo simulation methods, if you want to understand, say this. What is Monte Carlo simulation? Yeah, look at this. The Monte Carlo simulation is a mathematical technique that predicts possible outcomes of an uncertain event. Okay, mathematical technique. Remember few terms. Mathematical techniques, possible outcomes, uncertain event. Uncertain means which we have not seen at all. Up till now, nothing has happened. So here we can create various scenarios. In those scenarios, we test what will be the effect on my financial condition. Means, for example, I'll give a simple example. Suppose I am in a job and I am having a home loan of EMI, let's say huge, let's say 35,000. 35,000 is a huge amount for me. Somebody can say that I am having a EMI of, let's say, 1 crore. You see, in Mumbai and Pune, if you go, and Delhi, the home loans, the houses are for 2.5 crores, 3 crores. Mumbai, the houses are for 4 crores, flats. And then the home loans, around 75-80%. Right? 75% if you consider 3 crores home loan. What is the EMI? So it is obviously huge. You can anyone can debate on this. Okay, that's a separate issue. But coming on this part, let's say I'm having a home loan. Let's say a decent person. I'm having a home loan of, let's say, with EMI of 35,000. So what are the various scenarios which I need to consider? Tomorrow, if my job goes, then what? Will I be able to sustain this much huge EMI? That is Monte Carlo. What will be the effect on my financial conditions? So in banks, what do we consider? Similar examples we take. For example, it will take that tomorrow if the repo rate increases by 1%, tomorrow if there is a China-Vietnam war, tomorrow if there is a Russia-Ukraine war blows up, America attacks anyone, then what will be the effect on the commodities? What will be the effect on the banking? All these things are considered. So Monte Carlo means simulation, various methods of simulation. Okay. So coming back to our question, got it, everyone? Coming back to our question, it is, say this. Now look at the options, because first you need to understand this. So what is that? Yeah. Actual historical movements of the underlying asset starting from the current value of the asset. So historical movements, okay, starting from the current value. Projected historical movements of the underlying starting from the current value. Actual historical movements of the underlying starting from the future value. And sample of randomly generated price scenarios. Randomly generated. Now what can be the answer over here? Everyone type fast in the comment section. Let me see how many of you are typing the correct answer. Very tricky one, this one. Very tricky. I'm seeing many of you are typing this amounts ABC? The answer is none of these ABC. The answer is D. How can you have, see this, what is the definition we just now saw? Future rated, okay, means future scenarios. So when we are talking of future scenarios, what is this? Historical, back means history, historical. How can you have a historical movement in Monte Carlo, right? So that's why the answer is D. Randomly generated price scenarios. Price means what? What do you mean by price scenario? Price means the various pricing of the bonds. That is known as the price scenario. Okay. In which of the following methods to calculate the change in the value of the portfolio, the user has not to make any explicit assumptions? Explicit means what? Okay, firstly understand, not to make any assumptions. Okay, so where not to make the assumptions? Correlation method, historical method, Monte Carlo simulation, and A and C both. See, A and C means correlation and Monte Carlo. So A and C both. So what can be the answer? Everyone, let me see it again. Again, tricky question. Very tricky. Let me see. Correlation. What is correlation method? This you have studied in your ABM. Correlation regression. What is correlation method? Correlation method means any relationship, means R we calculated, coefficient of correlation, right, between the two elements. So that is correlation. What is Monte Carlo? Just now I told you, scenarios. So in both of them you have to make some assumptions. Monte Carlo is a futuristic thing, right? So that's why you have to make assumptions. Correlation, again you have to relate something, so assumptions. In history, you don't have to make any assumptions. Historical means it's based on facts. So not to make any explicit assumptions is historical simulation. So that is the answer. That's why I said tricky one. This was a real tricky one. Both the two questions, first and second, were real tricky one. Okay, move on. In which of the following is the usefulness of VR? Usefulness. Why VAR is useful? Firstly, what is VAR? What is VAR? Value at risk. Value at risk. Okay, what is VAR? Value at risk. Okay. So what is value at risk then? What do you mean by value at risk? I'll explain it. See, it's simple. Let's say I'm having a Reliance share. Okay, Reliance. What is the cost of that? Roughly take it to 3,000. Okay. So what is my value at risk now? Now this 3,000 I have invested, means 3,000 is gone from my pocket. I am having this Reliance share. But is this complete Reliance 3,000 my value at risk? No. So let's draw this mean line of 3,000. This Reliance share is 3,000 mean line. Now if the Reliance share daily fluctuates, daily, okay, it fluctuates like this. Okay. So at above it goes to around 3,050 rupees here, below it goes to 50 rupees again here. Daily fluctuation is this much is enough. Okay, so minus 50 over here. So what is the total fluctuation then? This 50 and 50, 100. So this value at risk of mine becomes this 100. 100 is my VAR. Okay. So similarly, if I am having this, I am talking of one share. Let's say I am having 1,000 shares. So this 100 into 1000 again, this much will be my VAR, right? So always remember, VAR is different than the investment price. Always VAR is different than the investment price. So now let's come to this question. Which of the following is the usefulness of the VAR? Good tool for fund managers for protection of customer business. So good tool for fund managers, of course. Translate portfolio exposures into potential P&L impact, right? P&L impact. Of course, it will give me, if I am 50 rupees up, I am profit. I am in profit. If I am 50 rupees down, I am in loss. The vital component for current best practices. So best practices, and that also current. Right now, the whole world, whole banking system moves on VAR. All financial system, in fact, meets the external risk management disclosure. Obviously, external means what? Just now I gave you this example. This Russia-Ukraine war goes up, then immediately the Reliance share goes down by 50. So external risk, market risk is also met over here. So the answer is all of them. 1 to 4 all. Okay. The process where model based VAR is compared with the actual performance of the portfolio is called as, see here, model based is compared with the actual performance. So it is called as back testing, stress testing, downside potential, and duration. All these are 4 different terms and very important terms in your BFM, all of them. Okay, I'll explain you in one line each. Back testing. Back testing means the historical performance. Historical performance is compared with the scenarios or whatever my criteria are. Stress testing. Futuristic, which has not happened in history at all. Corona, remember this word COVID. COVID had never happened in 100 years before. So if you do the back testing for COVID in 2019, COVID happened in 2020, it started, right? Suppose if you do the back testing in 2018, let's say, if I would have done back testing in 2018, I would have found no COVID at all. I'll say, what is the use? So stress testing means it is that criteria which says what has not happened in the history might happen in future. Okay. Downside potential. Downside means what can go down, means what can bring my overall portfolio value down. And last one is duration. Duration are of 2 types. One is this Macaulay, right? And second one is modified, right? Modified. This you have already done in your JIB also, in your ABM also, right? I won't be focusing more on this. So the answer over here is model based VAR with the actual performance. So the answer is A. Actual performance. Actual performance is always a history, right? So the answer is this, A. Okay, got it everyone? Next one. Which of the following is used to determine the possible changes in the market value? Always try to underline this, market value of the portfolio that could arise due to non-normal movement in one or more market parameters. Non-normal movement. Just now I give you the examples or meanings of all this: back, stress, downside, and duration. So what is the answer now? Immediately it should come to your mind. Everyone, fast. Immediately. Let me see in the comment section. Everyone, fast. In the comment section. Yes, it is. Comment section, fast. Yes, it is. Simple one. Just now I give you futuristic, stress, non-normal. What has not happened in future, in earlier year. Let's see the stock prices. Okay. Suppose let's say I am talking again of Nifty only. Nifty means our stock market, Nifty. Okay. Nifty was going like this, something like this, okay. This was up to 2019, 2019, okay. Then came COVID and Nifty went down. So this is known as non-normal movement. This was a 2020 scenario, right? So this is known as a non-normal movement. This is one-off case. So this non-normal movement is studied under stress testing. Okay. Which of the following techniques are covered by stress testing? So which of them are covered by stress testing? Okay. Simple sensitivity, scenario analysis, maximum loss, and EVT, extreme value theory. So stress testing covers which of these techniques? Stress means what? What did we see about stress testing? Means what all scenarios can happen, what all can be the effect on my portfolio. So in this, everything will be covered over here. Simple sensitivity also, scenario also. Scenario means again we are talking of Monte Carlo. Maximum loss also, and EVT also, extreme value theory also. Okay. So all 1 to 4 all. What is simple sensitivity? Now this word simple sensitivity means what? I'll tell you. 90% of you who are watching will say simple means something simple might be there, isn't it? Simple testing means what? Simple sensitivity. Something simple will be there. Because we have this word simple over there. Right? But remember, simple sensitivity is the most important test, most important. Actually, I'll tell you how it works. Simple sensitivity is the main method, main. Okay, this is the main method. Okay, let me show you on Google only. Okay, simple sensitivity is the main method. Okay, okay, let me show you that only. Let's go to Google again. Google is the best guru, right? Isn't it? Say this. Simple sensitivity analysis can be performed in different ways. Look at this. What did I say? It is a main method. This is a main method and it can be performed in different ways. What are the ways? Varying one input at a time. What is this varying one input at a time? It means correlation. One input at a time is correlation. What is correlation? Studying the relationship between two factors. That's it, correlation. Using Monte Carlo simulation. So what is this simulation? Right? Applying tornado diagrams. What are these tornado diagrams? We don't have in CAIIB, but tornado diagrams are a part of your EVT extreme value theory. Tornado. What is tornado? Tell me, what is tornado? We have not seen tornadoes over here in Indian continent. Hardly we see somewhere. But in USA, you'll see the tornado is a regular feature. Just type on Google tornadoes in USA. You'll see everywhere. Because they are used to this weather. So that's why they call this tornado situation or they call this tornado diagrams. Here we call it EVT, extreme value theory. So again coming back, what did I say? Simple sensitivity is not that simple. It is a main method. It has the parts, means under it works all these things. So let me come back to the question again. So here, simple sensitivity over here, as I told, it has various methods. These three are given over here. It can have many methods. Okay. This 3 means what? What scenario in Monte Carlo, right? Scenario, or I can have this maximum loss, max loss. I'll consider all of them and EVT also. EVT, okay, extreme value theory. So the answer is 1 to 4 all. All of them are used. Okay. The dash isolates the short-term impact on the portfolio's value of a series of predefined moves in a particular market risk factor. So who isolates? Means what? Here we are again talking of that Nifty. Right, this part. 2020. Here we are talking of this. So who isolates? Simple sensitivity, scenario, maximum loss and EVT. Again you will get tricked in this question. I'll tell you. Again you guys will get tricked. Many of you will answer the wrong answer. I'll tell you. Who can tell me? See here, again many of you have typed EVT, extreme value theory, but no, EVT is not the answer. The answer is again simple sensitivity. This is the main test. This will do all the job and EVT is a part of this. So the answer is simple sensitivity. It isolates. In correlation you had correlation and regression. You had this ABM. You had this, right? There's a topic on isolation of the waves, right? So those methods are called as, those come under the simple sensitivity. Okay. The dash specifies the shocks that might plausibly means certainly affect number of market risk factors simultaneously at the same time if an extreme but possible event occurs. So who gives me that shocks which all of them might come at the same time? Simple sensitivity, scenario, maximum loss or EVT. Who gives me this? All of them might come at the same time. Yeah. Who gives me? Think. Yeah, here the answer is different. Okay, the answer over here is, again, all of you are typing simple sensitivity. The answer is scenario analysis. Okay, scenario analysis will give the various factors which might come all at the same time. Okay, means many of you have got afraid. Simple sensitivity. So all of you have typed simple sensitivity, right? So the answer is scenario. Okay, that is the answer. Got it? The dash approach assesses the risk of a portfolio by identifying the most potentially damaging combination of the moves of the market risk factors. So, potentially damaging combination. All the damaging worst combinations come at the same time. All the worst. Yeah. Here you are right. Whatever you are thinking is right. The answer is, okay, it is among these two. Extreme value theory or EVT. Again confusion. Many of you are still again going into this logic of extreme value. Okay? Again confusion over here. Think over it. Think over it. What is the answer in this extreme value theory? Is it extreme value theory? Yeah? Okay. Let me cover this. Okay? Let me cover this part. So, because you need to have a clarification on this maximum loss and EVT. Okay? So, let's go one by one. EVT, extreme value theory. Again, Google Guru, right? What is extreme value theory? Extreme value theory analysis is a branch of statistics. Are you able to see this or no? No. One second. Let me show you over here. Extreme value theory is a branch of statistics dealing with extreme deviations of the deviation from the median probability distribution. So extreme deviations. That is extreme value theory. Okay. And what is maximum loss theory? See this. The probable maximum loss theory is the maximum loss that an insurer means here you can consider the bank also, okay? Bank or financial institution is expected to lose on an insurance policy. Now, if you see the banking, the logic remains the same, okay? So, it is maximum loss that the insurer would be expected to incur on a policy. So, because basically this is the risk management, right? That's why we are having this insurance, because who carries the maximum risk in life? In financial world. In financial world, always remember maximum risk is carried by the insurance companies or this CDS companies, credit default swap. Whoever gives you the insurance guarantee or money guarantee carries the maximum risk. Again, insurer is expected to lose on an insurance policy. Similarly, over here in your banking space also, bank is expected to lose on any loan or on any portfolio of loans. Okay, so that is basically maximum loss and EVT. EVT is just talking about the deviations, maximum deviations, and maximum loss is talking about the what all can be the maximum losses and how much will it affect my portfolio. Got it? So coming back. So now what is the answer? The answer over here is this. What are we talking of? Potentially damaging combination. So we are talking of this maximum loss. Here we are talking of maximum loss. Okay. So let's start without wasting the time. Credit risk. Now what is the credit risk? See here, always remember credit risk means relates to the credit worthiness of the buyer, could result in non-payment of the export bills due to any reason like financial crunch, default, insolvency, and anything. Now understand, one important point about credit risk is always related to two aspects. Okay, one is a counterparty and second is this country risk. Okay, let me draw it over here. Credit risk will always relate to two parts. Okay, one is country risk, country, and second is counterparty risk. Counterparty, right? What do you mean by this? country and counterparty risk. Here, firstly understand what is credit risk. Relates to the credit worthiness of the buyer, okay? Basically of the buyer, could result in non-payment of the export bills due to any reason like financial crunch. Now here the financial crunch is a typical question point given over here. Defaults, insolvency. Now all these points relate to the counterparty over here. Financial crunch of the counterparty, defaults by that counterparty, insolvency of that counterparty. Now, all these three aspects can definitely relate back to the country also. For example, I'll give you. Suppose if you have sold anything in, let's say, Afghanistan, any country, Afghanistan, okay, or North Korea, okay. What happens now? Even if your party is well off means if that party is ready to buy, say, give you the money, that party is good, financially that party is good, the transactions are good, everything is okay. But what happens typically, the country goes into default. Then also it's a risk. Because if tomorrow Taliban government says that no, nothing doing, no foreign exchange will go out of my bank from today. Even if your party is good, what will you do? Your payment is blocked, isn't it? This is a major problem for the country risk. This country risk has arose in many of the countries recently also. To name the few, all our neighbors. Check all our neighbors. Almost all. One is this Afghanistan. Second is Pakistan. Look at this, what has happened. Look at Sri Lanka, what has happened, right? Means all these three countries, these are the major three neighbors of us. There is also Nepal, but Nepal doesn't have much foreign exchange as such. Okay, so these three countries will always have always been the credit risky countries, to be frank. Okay, because there is a huge country risk in this. Now counterparty means what? The country is good, but the counterparty is bad. Means your buyer is bad. Your buyer is not ready to pay. So this can be willful also. Suppose somebody is in USA, your buyer is in USA, your buyer is in Europe. So aren't the countries good? The countries are good. But what is happening? Your buyer is not okay. So that's why I'll tell you credit risk will relate to two parts always. One is country risk and second is counterparty risk. Okay. So credit worthiness of the buyer. How will you check the credit worthiness of the buyer? It's very difficult to check credit worthiness of the buyer. So that's why we should always, to cover this credit risk, we always try to use one element. What is that element called as? We always try to use LCs, letter of credit. Through LCs, the credit worthiness of the buyer is bypassed. Okay. So in LC, what do? We give typical, that bank gives us the responsibility, means gives us the assurance of payment on production of the documents, right? So that's why the credit worthiness of the buyer is gone and non-payment of the export bills by the buyer is gone. So typical credit risk is covered by LCs. Okay. LCs or even guarantees you can take. Guarantees means guarantees are also allowed. Okay. Financial guarantees. So they can be also allowed. So remember always, credit risk is always countered using LC or guarantee, or there is one more, but many of you might not know, but that is called as availization, similar to guarantee. Avail. Okay. Avail means giving a stamp on the bill of exchange. Suppose if this is the bill of exchange. Okay. Now here you are the drawer, you seller signs it, right? Here the buyer signs it, buyer. But in availization, what happens? This buyer also signs it, and here on this bill of exchange, face of it, bank will sign it. Bank will say, I will pay if the buyer doesn't pay. So this is a third party assurance you are getting, and that also from the bank, good bank. Okay. So that's why this is known as availization. So to counter the credit risk, we always have these three things: LC, guarantee, and availization. Okay. Now second is legal risk. What is a legal risk? Look at this. Let me remove this now because this you have understood. Legal risk. What is the legal risk? Understand this. Relates to any amendment in the laws of the seller's or buyer's country which could result in inability of the seller to export or of the buyer to remit the proceeds of the invoices. Means what? After all, this again relates to country risk. A part of the country risk. Here, country risk can have various parts. Country risk. It can have legal. Like as I said, just now I gave you this example of legal. Afghanistan. Taliban took over, and then it's their own laws which are going on. So relates to any amendment in laws of the seller's or buyer's country, which could result in inability of the seller to export or of the buyer to remit the proceeds, isn't it? Means seller is ready to export, your party is good. But the problem is the country is saying nothing doing, no more goods to be sent outside this country, no more exports, so everything is stopped. Similarly for buyers, no more money to be sent, forex to be sent outside my country. So that is also blocked. Okay. So country risk could relate to legal, or there are various risks in country. I'll give you this PESTEL. This is known as a typical risk analysis, PESTEL. Every country is always measured based on this PESTEL. Political, economic, social, technological, environmental, and legal. Always remember this. PESTEL analysis is done for each and every country before doing any business with them or investing in any country like this. Okay. So this is a typical one. I'll give you one more example in legal risk. Suppose if you go in many of the Middle East countries, the checks which we have, checks in India, checks are typically for how many months? Maximum 3 months, right? Beyond 3 months, you can't use those checks in India. But in some of the Middle East countries like UAE and others, you have those checks which are being used for almost 2 years also. Because that is a legal process, legal system, right? In India, you can take the collateral, right? And nobody stops you. Suppose in some Middle East countries, the collateral is, if it is to be taken, how can you take it if you are a foreign bank over there? You can't take it because there the laws are different regarding the property. So it depends on those laws. Okay, that's why it's called as a legal risk. Means whenever you have to enter any country for doing any business, you have to typically be sure that what are the legal problems in that. Okay. So legal risk continued. This could be due to the embargoes on the countries, ban restrictions on the export of a particular goods, ban restriction on remittance of funds to particular country. I'll tell you one thing legal like ban. What is ban or restriction of export on export? Look at this. Recently, India had banned this import of all these laptops, foreign-made laptops. Also export, I'll write it over here. Here, import of laptops was banned by India, right? Import. So this is again a legal risk. Import of laptops. Okay. Similarly, export. We have banned what recently? What have we banned? Can anyone know? Tell me? What is the export which is banned by India now? Recently. Rice, correct. Rice is banned. Second, wheat is banned. Wheat. Okay, wheat is banned. Then third, what is banned? What is India banned? Many of the things are there. Onions have been banned now. Onions. These have been banned. So these are typical bans which arise within that country, which the country gives these bans. So embargoes means stoppages on the countries. Ban restrictions on export of a particular goods, ban restriction on remittance of funds. Okay. So funds transfer, like I gave you the example of Taliban, right? So these are typical examples of legal risk. Everyone subscribe to Officers Adda 24/7 YouTube channel. In this channel, you will get the latest updates from IIBF explained. Okay, updates from IIBF are explained over here, latest ones. Okay. So what is the point is many of the IIBF notifications which come are very difficult to understand by a common banker. So they are explained it over here. And second is you get free YT series, YouTube series. Okay, free. So whatever is free, I would suggest grab it fast, isn't it? Now similarly, see here, right now you are watching BFM YT series. Similarly, you can have the YT series on, you will be having it on ABM, for ABFM, for BRBL, all the 4 subjects by different mentors. Similarly for JIB also you are having it, right? So subscribe to this channel, click on the bell icon, click on the like button, share it with your friends. Do it fast. Because remember, sharing is caring. That is very important. Okay? Country and political risk. Now, what do you mean by this here? Just now we saw some part of the country risk, but again we'll see the political risk now. It relates to the development in the country of the buyer or seller leading to default in export or payment. So developments in the country, developments means these developments are always dynamic, remember, or buyer leading to default in the export or payments. Okay. So developments can be dynamic means suppose if the government changes in many of the countries, so immediately there are bans, right? Similarly, for example, right now in US, what is happening? They are coming up with the elections, right, in 24. So now the new candidate has told that he'll put a tax on India. Donald Trump, he has told that he'll put a tax on India if he comes to power. What is this? This is the intention of the political risk, right? Some other countries have also done the same. Means China is generally the is not a friend of good friend of India. So it always tries to put some taxes, something on Indian goods, right? So these are all political risks. There are also friendly countries as such, like in UAE for India. They are typical friends. They have allowed freely everything. Okay. So relates to the development in the country of the buyer or seller leading to the default in the export or payments. This could be due to uncertainty in laws, right? Uncertainty in laws. Uncertainty in financial position of the countries. Remember, financial position of the countries. This is typical. Okay. Discordant relationship between the countries or fluid political situation. So discordant relationship between the countries means friends and foes. Means going against each other. Okay. Discordant means cross relationship. And fluid political situation. Fluid means what? Like in if you see this fluid political situation, I'll give you a typical example. In many countries, like for example, in this Israel, if you check Israel country, they have so many elections. Every 7 months, they are nowadays having the elections, and the government changes. So that is fluid situation. If you go typically in South African countries, typically their government changes every now and then. So that is fluid political situation. Okay. So fluid means what? Very fragile political situation, right? So developments, uncertainties in law, financial position of the countries, and discordant relationships. These are the typical risks. Okay. Let me come to few more. Countries' weak forex reserves could position could lead to the shortage of foreign exchange or inability to buy foreign exchange, resulting in externalization issues. Now, this is a typical and this needs explanation. Weak forex reserves. Okay. Okay, just tell me one thing. We'll compare. We are neighbors over here, India and Pakistan. We'll compare India and Pakistan. Okay. So now, India will say Bharat now. India is not India. We should say Bharat now because how can a country have two names, isn't it? So Bharat. Okay. So now, let's say in Bharat, what happens? Countries weak forex reserves. Look at this point. Huh? Right now, what are the forex reserves of India? Anyone knows? Anyone idea? Any idea? It is 600 plus billion. 600 plus billion. Okay. 600 plus billion. What are the forex reserves of Pakistan? Roughly 7 to 8 billion. 7 to 8 billion. Where is 600? Where is 7 to 8? So this is known as weak forex reserves. World Bank says here every time World Bank has given and in fact IMF has given a simple rule. IMF says that which country is stable country? Which country do we call it a stable country? The stable country definition they have given any country whose forex reserves are sufficient are sufficient for next
9 months for imports. For imports. So that country is called as stable. Okay. Now look at India's 600 plus billion reserves. Every year, every month, India requires around. This is what the general whatever is found is around 40 billion for imports. Every 40 billion per month. Okay. Now we multiply it by 9. 9 for the 36. So 360 billion we require for 9 months. Right now, how much are we having? 600 billion. So we are much more than the stable. We have a best rating. That's why India is having nowadays, and this rating is very high for India. Okay, and it is going up constantly. So important point always remember over here. Countries' weak forex reserves will always lead to shortage of the foreign exchange and inability to buy foreign exchange, resulting in externalization issues. Now look, if you look at the inflation, if you look at the typical inflation, then what happens? If you look at the inflation, okay, inflation in Pakistan has rose heavily. Similarly, in Sri Lanka, rose heavily. Why? Because less of the forex reserves. Okay, this less forex reserves always leads to high inflation. So this is a typical reason. Got it? So that's why any country's forex reserves will lead to a problems of inflation, political problems, legal problems, social problems. All these problems here. After all, it's money. If you don't have money, nothing can means you can't play games with money. Either you have this money or you don't have the money, isn't it? Everyone download Adda 24/7 app on your mobile. In this app, you will be getting the premium study material plus live classes, ebooks, tests, everything. Whatever you need, you will get it over here. Okay. Operational risk. Operational risk relates to operational issues at both ends or even at the supporting organization's place. Means what do you mean by this? Both ends. What are the both ends? There is a typical here. Let's look at every export or import transaction. There is a typical exporter, right? From any country it is. Then second we have typical importer, the one who buys, right? Importer. Now the in between, how will the goods over here should reach from the exporter to the importer, right? But how will they reach it? It reaches through supporting organization, means shipping company. So shipping company, okay, shipping company. So this is known as the third party or shipping the supporting organization. Relates to the operational issues at both ends or even at the supporting organization's place. Means if the exporter is having some problem, then that exporter won't be able to ship the goods. If the importer is having the problem, the importer won't be able to give the funds, right? Funds back because funds should be received from importer. So importer won't be able to give the funds, right? Then strikes at the seller's factory. So this can also happen. Strikes at the seller's factory or even seller's raw material suppliers factory. So if some exporter is getting some raw material from somebody to prepare the goods, right? So somebody is supplier to this exporter also. So if there is a strike or some problem with that supplier, even then raw material will not be received. So exporter won't be able to export, manufacture and export. Then this raw materials suppliers, transporters or loaders or banks or clearing agents anywhere. Even if there is a strike in the shipping company, there is typical strike over here. Then also it's gone. You can't do anything in that case. So that's why operational risk relates to in any ways if you can't give the service. It can be due to strike, it can be due to dacoity, it can be due to terrorist attack, it can be due to floods, anything. Okay. Similarly, operational breakdowns or failures of systems, connectivity and communication, disruptions, commotions and other strikes or errors of by operating staff could lead to non-shipment or delay in shipment, shipment of defective or damaged goods, delays in making payments or receiving payments. So anything which relates to the stoppage of any transaction. So what are the transactions over here? Look at this. Failures of systems connectivity. Communication. So if there is no communication, how can you communicate with that guy in USA? Okay. Disruptions, commotions, and other strikes. Errors by operating staff. Errors by operating staff is also an important part. Huh? Error of commission and omission. We have this. We had this in your JIB, right? So these errors can also lead to huge problems.
Friends, welcome to the Scholar series of BFM. Here we are covering important theory, questions, objective questions, and some numericals. So let's start without wasting the time.
If USD to INR rate is given as 48.10 and pound to USD rate is given as 1, what is the rate of pound to INR? Now, what is this? What is it to be used? We are using what over here? We'll be using chain rule, right? Chain rule. What is the chain rule? When you don't know the rates of any currency vis-a-vis your local currency, okay? Means this pound to INR. If you don't know the rate, do you know the rates of pound to INR over here? No. But you are having the other rates, means some base currency rates you are having. So what do? We use the chain rule. What is the chain rule? We use it like this. You have pound to, what do you want? Say this, pound to INR. I'll write it P to I. Okay, let's keep it simple. P to I. So it will be what? Pound to USD into USD to INR. Chain rule, you have studied this in your JIB also. So pound to USD rate is what? 1. So keep it 1 only. USD to INR is what? 48.10. So your answer will be 1 into 48.10. Okay, so D is the answer. Isn't it? Simple one. Next one. Chalo. If USD INR rate is 48.10, USD JPY rate is 91.50, what is the rate of INR to JPY? This is not simple. Calculate the rate for 100 JPY. Remember, JPY is always, JPY means what? Japanese yen. I'll write it. JPY means Japanese yen. Okay, it is their currency. So Japanese yen is always calculated in terms of hundreds. We always calculated 100 JPY, 200 JPY, 300 JPY. Rates are quoted in that angle. Why? Because the currency is very small. Now it doesn't mean, remember, the currency is lower. It doesn't mean the country is lower. Japan is the most developed country, one of the top 5 developed countries in this world. Okay. So once you have this top 5 developed countries and their currency is lower than that of Indians, you'll say then it is less developed than India? No, nothing like that. Currency is not at all related to the development of any country. Okay. So now, Japanese yen. Okay. So what is the rate now? You want what? INR to JPY. See here, it is INR to JPY we wanted. INR to JPY. I'll write the J over here. Okay. So again use the same chain rule. INR to USD. USD into USD to JPY. So are you having both the rates? INR to USD. Are you having INR to USD? See here, USD to INR rate is given. INR to USD into USD to JPY. This is what you want. So how will you do this? See here, we always, when I am saying this INR to JPY, I want this rate, and JPY to INR. See here, it's actually reverse one. Whenever we find this rate, we find it this way. JPY to INR. This is what we find out. And then JPY to USD into USD to INR. This is what we find out always. So now first find out this. If you want, you can reverse this. If they ask you in INR to JPY, you can reverse this later. Because this rate is difficult to find out. This rate is very simple. So JPY to USD, what is the rate? JPY to USD. And USD to INR, you know it. See here, this is 48.10. And this JPY to USD is, you don't know. This is 91.50, but that is what? This is USD to JPY. So that is 91.50. So if I want JPY to USD, this is upon 1. So if I want JPY to USD, it will be J upon U equals to 1 upon 91.50. Okay, that will be the rate. So now I've got the JPY to USD rate. Multiply this, put it over here. So my answer will be 1 upon 91.50 into 48.10. Okay, so what is the answer now? Do it on the calci, everyone. Try it on the calci. Yeah. Let me see in the comment section. Let me get the answer in the comment section. Everyone, give me the answer in the comment section. 48.1 divided by 91.5. Okay. So it is 0.5256. 0.5256. Now this is for what? This is JPY to INR. Okay, JPY to INR. But they want it for what? 100 JPY. So multiply this by 100. So it will be 52.56. Where's the answer? Check this. 52.40 or 80. They'll give you this 56 answer, or 50 they'll give you. 60, let's take it. This will be around this 60. So 52.60 roughly. 56 and 60. In exam, they'll give you the exact answer over here. So it will be 52.60 or 56, whatever this rate is. Okay, got it? Always do it for hundreds. Got it? JPY is always calculated in terms of hundreds. When the exchange rate is fixed by monetary authority of India, of any country, it is called as. Here, when it is fixed by the monetary authority, means what? RBI tomorrow says that dollar to INR rate, okay, is, let's say, 70 rupees, fixed, no changes in that. It will not fluctuate. It is fixed by this monetary authority. So in this case, what is it called as? Direct, indirect, floating, or fixed? Direct, indirect, floating, or fixed? It is called as fixed, isn't it? It is fixed by the monetary authority of that country. So it is fixed, but obvious. See here, these things are done in many of the countries. Like I'll tell you, there is huge interference in the currency by many of the countries directly. I'll tell you where. China. If you check China, their currency is what? What is the currency of China? Anyone can give me? What is the currency of China? It is yuan, right? Yuan. Main currency, there are renminbi also, but main is yuan, right? China interferes a lot in their currencies. It is administered rate, you can call it. Means administered means it is administered by the government, direct interference. Whereas in India, it's not fixed by any RBI or anyone. It is based on demand and supply. China interferes in this currency, and if it wants, it can reduce the rate. If it wants, it can increase the rate whenever it wants, whenever the government decides. So this is known as this interfered rate. So it is fixed by, they say that yes, we are also free floating currency, but nothing like that. Okay, it is fixed. Got it? Everyone subscribe to Officers Adda 24/7 YouTube channel. In this channel, you will be getting the latest updates from IIBF on JIIB and CIIB, various notifications. Change in timing, change in subject, change in this. They give this now during the exam days. IIBF gives many notifications. So all of them you get it immediately on Officers Adda 24/7. You need not go to that IIBF website every now and then. Okay. So, and secondly, free YouTube series. Right now, what are you watching? You are watching the free YouTube series. So similarly, you'll be getting the free YouTube series on all the subjects of JIB and CIB, all of them. Okay. So subscribe to it right now. Click on this bell icon. Share it with your friends. Very important. Okay. Bell icon is important so that you get the notifications. When the exchange rate is fixed by the market demand and supply position, it is called as market demand and supply position. Means whatever, if your demand is high, your rate goes high. If your supply is high, your rate goes low. Do you know this concept? Suppose if demand and supply means what? If the demand for dollar goes up, demand for dollar, let's say it will go up. If it goes up, then what happens? The rate for dollar becomes what? The rate for dollar will be high or low? Give me. Will it be, just type H or L. Will it be H or L? If the demand for dollar is high, will the rate for dollar will be high or low? It is high, correct? So if See, your logic is very simple. If the demand for any commodity is high, the rate for that commodity will go up, right? This happens, when does this happen? This happens when you have huge fund flows coming in. Suppose if in India there are large amount of dollars coming in, large dollars, large amount. Everyone is investing dollars, okay? Large dollars are coming in. Then what will happen? In that case, the supply will increase. Supply, okay? Supply will go up. If supply goes up, then what happens? The rate goes down. So the dollar rate will go down, right? So when large dollars come in, supply goes up, supply of dollar goes up, and the rate goes down. And vice versa. If the dollars go out of the country, if all the investors are moving out of the country, so dollars are moving out, then in that case, dollars are moving out. Okay? If dollars are moving out means what happens? There is a less supply of dollars in this country. Then the rate will go up. So what is this called as actually? Whenever it's decided by this demand and supply position, it is called as what? Direct, floating, indirect or fixed rate. It is called as floating rate. Correct? It is called as floating rate. Remember. Fixed and floating, these are the two main rates. What is this direct and indirect? Direct and indirect rates are also there. What do we use in India? So if I say $1 equals to 80 rupees. So what is this now? Is this a direct rate or indirect rate? Type in the comment section. Is this a direct or indirect? Give me the rate. Direct or indirect? What is this called as? It is? What do you say, guys? Direct or indirect? It is called as direct rate. Direct. Whenever your dollar, remember, it's the logic is simple. Your dollar is fixed and your rupee currency, local currency is fluctuating. It is called as direct rate. Indirect is reverse. Suppose if I give you £1 equals to $1.5. So here what is happening? Dollar is fluctuating. So this is called as indirect rate. When your dollar is fluctuating, it is called as indirect rate. Okay. So now remember, we in India should move out from this rate to this rate system, because we must develop ourselves so big that we must also have this indirect rate system. Dollar should fluctuate and rupee should be stable. Right now it's the reverse thing. But although now again I'll tell you, don't confuse yourself with the currency, because if you look at it, pound is now having the indirect rate, okay? But pound is having what? Indirect means what? Is this economy bigger than that of India? No. Indian economy is bigger than that of this Britain economy or London economy. Then also they are having this indirect, because these rates were fixed long back. That's why they are still prevailing. Now within few years this will go. This won't remain for long. So, because if the pound is not growing, if the country is not growing, will this indirect rate remain? No. US will say no, forget this. Make this pound also in the direct rate. And in coming years, if we grow with such a speed, there will be a time when our direct rate will be converted to indirect rate. We will be the governing power, because we are already planning for growing to third number of the economy, right? We are right now at fifth and we are moving towards the third. So when we move towards the third, these rates will change. Okay. So this is got the concept of direct, indirect, floating and fixed, right? The term bid rate stands for bid. Bid means what? Bid rate. Bid offer, bid offer. Okay. Bid offer. It's like this. Bid offer. So you call it buy and sell. Buy and sell. So bid stands for direct, indirect, buying and selling. So it stands for, isn't it? Buying rate. The selling rate of a foreign currency offered by a bank is called as, just now we did it. Selling rate, sell rate is known as what? Yes. Give me in the comment section. Just now we saw it. Yeah, this one. Sell is what? Correct? Type fast. Offer, isn't it? Everyone download Adda 24/7 app on your mobile. In this app, you'll be getting the premium study material plus live classes, ebooks, tests. Whatever we need for clearing this GIB and CIB, we'll be getting it over here. So that's why download this app immediately and start studying. Don't just download. Okay? Start studying. Country risk is an example of market risk, credit risk, operational risk, liquidity risk. So country risk is an example of what? Yeah, it is credit. Okay, remember credit risk is of two types. Credit mainly. There can be various types, but mainly two types. Okay, one is country and second is counterparty. Counterparty. Okay, what do you mean by this? Credit risk, country risk means what? Your party is good, means A is selling to B. Let's say A is selling the goods to B. Okay, so B is good, but a country in which B is living is bad. Afghanistan, North Korea. So B is good. But the second part is counterparty. Your B is bad. Country is good. USA, somebody staying in USA, somebody staying in Europe. Countries are good, but the party is bad. So that is counterparty. So country risk is an example of what? Credit risk, isn't it? All of the following are the types of price risk, except, so which is not the type of price risk. All of them. Let's see. Price risk means what? Commodity price risk. The price of any commodity. What is the commodity? Commodity is anything. Dollar is also a commodity. Okay, currency is also a commodity. So commodity price risk. Exchange rate risk. That is also price risk, because if the dollar rate changes or the exchange rate changes, definitely the price will change. So this is also the part. Stock price risk and counterparty risk. Now it's typical one. Counterparty is what? Just now we saw it, credit. So is it a part of price risk? No, isn't it? So this is the answer. So these all are true, 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 and this one is false. And we want false only, which is not the type of price risk, right? Stock price risk, obviously, stock price risk is a part of price risk only, isn't it? In financial bond markets and in financial market, bond prices and yields are. So this bond price and yields are about directly or inversely related. Inversely, directly, inversely or directly, depending on the type of the bond. None of the above. So the bond prices and yields are always, they are always. Once remember the price of the this rate of interest, yield we call it. Yield means what? It's the rate of expected rate of interest. Here, what is yield? You need to understand that also. Expected rate of interest, expected ROI. Okay, that is yield. There are two rates always in any bond. One is coupon and second is yield, right? So coupon is always fixed. Once it is given, it's fixed. You can't change it. But this yield goes on changing. Expected rate goes on changing. If the expected ROI goes up, then the price of your bond, existing bond, will go down. Always remember. If the expected ROI goes down, your price of the bond will go up. So it is what? Inversely related, isn't it? In financial bond market or market, bond prices and yields are inversely related always. You see this, what happened in this, what October, just type on Google, October 22 to December 22. Check the US bond rates. US bond rate. Check this, you'll get this. In US, the prices of the bond fell like anything. Why? Because the rate of interest or the bank, their Federal Reserve, increased the rate of interest. So that was the point. Okay. Now, how to join this Offices Adda 24/7 YouTube channel or the Instagram channel or the LinkedIn channel? Scan this QR code. For this LinkedIn channel, scan this QR code, do one. For the YouTube channel, scan this black QR code, this one. And for the Instagram channel, scan this QR code. You can join it immediately. Okay? Because on these channels, we are giving free YouTube series, we are giving ebooks, we are giving tests, some of the sample ebooks, simple, some during the exams, we take various tests as such, free tests. So you can join this right now, isn't it? Rate of cancelling the original contract is means whenever we cancel the original contract rate, it is done at what rate? TT buying, TT selling, bill buying, bill selling. See here, cancelling the original contract rate, it depends on what rate are we talking of. Suppose I am calling buy rate, rate of cancelling the buy rate. Okay. So if I have purchased this dollar earlier, okay, if I have purchased it, I might have purchased it at what rate? I might have purchased it at either bill buying or TT buying, depending on what type of transaction it was. If it was a spot transaction, I might have done it at TT buying. If it was a bill transaction, I might have done at a bill buying rate. But cancelling is always done at the same rate. That is known as TT selling. Cancelling, here, cancelling means reversing that transaction. So that will be always done at TT selling. Rate of booking a new contract for next 1 month is TT buying, TT selling, bill buying, bill selling. See here, next 1 month I want. So just now I told you spot transaction, spot will always be done at TT. Whereas future transaction will always be done at bill. Okay. So it will be done at a bill rate. But bill means what? Booking new contract for 1 month. Which contract? Suppose if I say export contract, export. So export means what? Buying. So I'll be using bill buying rate. So I'll be using bill buying over here. If it's import, then I'll be using bill selling rate.
Hi friends, welcome to Adda 24/7. We are in the Scholar series for BFM. Here we are covering all the important theory, numericals, objective questions, case studies. So follow the series till the end. Also, follow the complete series, all the lectures. Okay, let's start. First one. The dash is a means to better capture the risk of the loss in extreme but possible circumstances. Now, what captures the risk in extreme situations but possible? Possible means here extreme but possible. What do you mean by this? Extreme but possible means it is not the regular thing which we think of. See here, I'll show you over here. Suppose if this is a graph, this is my regular scenario. But extreme means like this. But possible. So somebody might think that it's not possible at all. But COVID, nobody had thought of COVID before this 2019. But COVID came extreme, but possible. So which is the better means to capture this risk of loss in extreme but possible circumstances? Simple sensitivity test, scenario analysis, maximum loss, or extreme value theory. So who captures it better? Yeah, extreme but possible. In my earlier lecture, I've taken this, not this, but similar question. Okay. So some of you might think that answer I had given was simple sensitivity test, but that question was different. Here extreme but possible. Whenever you say extreme, extreme means it will come to extreme value theory. So your answer will be EVT. Extreme value theory is the concept which captures all the means last stage problems. Okay, last stage risks. Suppose if everything goes wrong in a regular market, if everything goes wrong, then what can happen? Okay, so that is basically the meaning of EVT, extreme value theory. Got it? Next. Universal Bank has purchased certain bonds which it wants to sell now. The bank expects some fall in the price of the bond. Which of the following type of risk is the bank facing? So now the bank is having the bonds. Now it wants to sell them. But it expects some fall in the price of the bond. So it is expecting the fall, means while selling also, it is expecting the fall. So which is the type of risk? So liquidity, market liquidity, asset liquidity, and credit risk. Yeah. Is it asset liquidation risk or market liquidity risk? Here specifically in that bond, is it mentioned somewhere that the market is down? Say this, market is down When we say the market is down, it means we are talking of market liquidity. Okay, market liquidity. It means that I'm talking of market liquidity when the whole market is down. Means this was a scenario in COVID. Okay, when we had COVID issue, the whole market was down. It was like this. Means that Nifty price was like this, right? So let it be any stock. It was down. Similarly for bonds. Okay, bonds also same scenario. So the is this related to market? No. So B will be out. Credit risk. Credit risk happens when the bond issuer is in a problem. If they would have mentioned that the issuer of this bond is facing the problem, okay, so then it would have been a credit risk. Here, credit risk means always remember issuer is in the problem. Credit risk, okay, it means the issuer of that bond. Issuer is in problem, okay, in problem, or the rating of that issuer goes down. So that is the basic meaning of this. Liquidity risk. Okay, liquidity means what? Liquidity is the risk faced by that company itself. Means if Universal Bank was facing the money crunch, then it would have been called as liquidity risk. So this is also not the answer. The answer is this: asset liquidation risk. Because there is a fall in the price of that bond, okay, then that's why it's called as asset liquidation risk. This is a real answer to the question. Asset liquidation risk. Got it? Next one. One day VAR of a portfolio is 50 lakh with 95% confidence level. In the period of 6 months, assuming to have a working 125 working days, how many days the loss of portfolio may exceed the value of the portfolio, that is 50 lakhs? What do I mean by this? Everyone, first you try the answer. Let me see. Let's see. Okay. Let's try both from both sides. You also and me also. First you try the answer. Here no options are given. See here, nowadays you are getting certain questions where no options are given. So this answer will be that type of answer where no options will be given. Okay. So what can be the answer now in this case? What do you think should be the answer now? How to solve this? See this. Understand this. One day VAR is 50 lakhs. Means what? 50 lakhs VAR is acceptable to me. Means if my loss is 50 lakhs, then it is acceptable to me. Understand this, whatever I am telling you. Everyone pay attention. If one day loss equals to 50 lakhs, okay, then it is acceptable to me. Acceptable, okay, acceptable. But beyond 50 lakhs, okay, not acceptable. That is my basic, the premise of this problem is this. Beyond 50 lakhs, not acceptable. Now what is given over here? One day VAR for 50 lakhs is with 95% confidence. So what do you mean by 95% confidence? It means that out of 100 days, see this, out of 100 days, 95 days, see this, 100 days, I'll write here days, I'm writing days. So out of 100 days, 95 days, okay, the chances are my loss will be within 50 lakhs. Within 50 lakhs. Okay. So out of 100 days, my 95 days, my loss will be within 50 lakhs. So what does it mean? It means for 5 days, my loss will be greater than 50 lakhs. That's what is the meaning. Out of 100 days, for 5 days, my loss will be greater than 50 lakhs. Now this is what you want. Out of 100 days, 5 days, your loss will be greater than 50 lakhs, right? So now it means that, suppose if I say, so out of 100 days, 5 days, my loss will be above 50 lakhs. Okay, that's my premise now. Now in 100 days, 5 days my loss will be beyond 50 lakhs. Now what is given? 6 months. In 6 months, they have given the working days as 125 days. So if in 100 days, for 5 days, my loss will be beyond 50 lakhs. So in 125 days, what will be the answer then? So cross multiply. It will be 125 into 5, right? It is direct proportion because it will be greater upon 100, right? So now solve this. What is the answer? 125 into 5. Or directly solve this like this. So 4 is a 5. So you can do it on the calci, man. That's simple, isn't it? Do it on the calci. Don't apply your brains in exam. We have to save our brains for some difficult tasks. Okay, don't waste on the calculations. So do it now. So 125 into 5 divided by 100. So 6.25 days, right? So for 6.25 days, my loss will be beyond 50 lakhs, and that's what is the answer. Okay, on how many times, that is days, the loss of the portfolio may exceed the value of the portfolio, that is 50 lakhs. So for how many times in 125 days will the loss exceed by 50 lakhs? It is 6.25 days. This is days. You'll say, how can it be 0.25 days? But remember, you don't think that much in exam. Exam, get whatever the answer is, write it in that block given here. There are some options given to you now, some questions where you don't have the options. You have to just type 6.25 days over here, days, okay? And then there on the computer screen, there's a, or there only, they'll be giving you the save button. Click on that save button, save, and then move on. Okay, that's what you have to do. Don't think what is 0.25 days, what is this, that's not your problem. Okay, got it everyone? Clear? Type in the comment section if you have understood it. Type in the comment section. Here, out of 100, 95 days it is within 50 lakhs. So for 5 days it is beyond 50 lakhs. So in 100 it is 5. So in 125 how much will it be? 6.25. That's it. Okay. Next problem. Here, this is also the another one. A 5 years 10% semi-annual bond has a basis point value of 125. The yield on has decreased by 5 basis points. What is the profit or loss due to that increase? What is this? Now this is your somewhere related to JIB. Somewhere, because this is a bond problem. Okay. So 5 years 10% semi-annual bond. What do you mean by this? 5 years 10% here. In any bond there are basically 5 elements. Okay, always remember. What are the 5 elements? Face value, then what? Coupon, then what? Tenor, period, N, then what? This market price, and next one is market rate, right? So market rate. Okay, so this price we call it P and market rate we call it R. This is also called as yield or asking rate or YTM or discount rate. Any name can it be called as. Okay, this R. So what is given now? 5 years 10% semi-annual bond has a basis point value of 125. So BPV value is 125. What do you mean by basis point value? BPV value. Now that's why I'm saying join the paid classes. Okay, join the paid classes. Very important. Okay, what is BPV? BPV I'll explain you in one line only over here because that's not possible to explain the whole concept. BPV means change in price. Okay, that is P. With respect to versus I'll write with respect to 0.01%. Remember this. Change in R. Okay, this is the meaning of BPV. 0.01% change in R. Okay, so now what is given? See this. Whenever my this 0.01% change, you can also write it as 1 BPV. Yeah? 1 BPV, 1 basis point. 0.01 means 1 basis point. Okay. What is 0.01%? Here, 1% means 100. Divide this into 100 parts and then divide it by 100. So that is 1 basis point. So now what is it given? it is given that when my R changes by R changes. Now look at this. Everyone pay attention to whatever I am saying. R changes, let's say upward. Okay. If R changes upward by 1 BP, 1 basis point, equals to price changes. Look at this, price changes downwards by how much? See here, it's given 125 rupees. So by rupees 125. Got this point? This is the meaning of this question. R changes upward by 1 basis point, price changes downward by 125 rupees. But what is given in the question? The yield has decreased. So in our question, is this R change upward? No. Here in our case, R is changing downwards. By how many basis points? 5. Okay. So 5 basis points means equals to price change. Now what will happen to the price change? Upward or downward? You tell me. Price change will be upward or downward? You type in the comment section. Is the price change upward or downward? Price change is upward. Okay, because R and price will always be in the inverse proportion. But by how many points? By how many rupees? This 125 is for 1 BP. This is 5 BP. Right? So 125 into 5. 125 into 5. So that is 625. 625. So now what happens? This is, what is this then? 1250 profit, 1250 loss. 625 profit or 625 loss. So what is the answer now? Price has changed upward. So price has increased. If I brought something for X rupees, now it is X plus 625. So I'm in profit or loss? I'm in profit. Got it? I'm in profit over here. Getting this point, everyone? See here, this concept you have to understand always. Very important concept. Okay? This concept is very important over here. You must get this clear in your mind. Okay? Next one. One sec. Yeah. Let's move on to the next one. Yeah. A security was held by the bank beyond the defense period. Bank suffered loss due to the adverse change in the value of the security. The bank was exposed to market risk, credit risk, market liquidation risk, and operational risk. This is the most simplest question. Let me see how many of you are able to answer this. Most simplest question. Most simplest. Yeah. Think over it. The security, read the question again. The security was held beyond the defense period. Beyond the defense period means what? What do you mean by this word beyond the defense period? It means what? What is defense period? This period means, suppose if the maturity of the bond, okay? Suppose if I'm having this bond and the bond's maturity is on, let's say 10th April. So my defense period means I must submit this bond to that company on 10th April. It's like the FD. Let's say, forget this bond. Think of it as a FD. Suppose if you are having a FD of some cooperative bank or some smaller bank. Okay, I won't name any bank sector now. Cooperative bank. Isn't cooperative bank good? They are good. So suppose if you are having some FD of some XYZ bank, okay, which is maturing on 10th April. So what is your duty? Your duty is to give back that FD to that bank and get your cash. Right? Get your cash. Give the FD and get your cash. Right? Now if you don't give this FD back on 10th April and further you carry on and on, you forget it. You carry on. Now what happens? On some date in some, let's say August, you don't look at it. On some date in some August, this bank faces the liquidation. Means the bank doesn't have any money now. The bank has gone into bankruptcy. Now your FD is of zero value. Now whose problem is it? Is it a market risk, credit risk, market liquidation, or operational risk? It was your duty to give back the FD on 10th April. You didn't give it. You have carried it for infinite time without thinking of it. So that is basically the operational problem. Operational risk. This is known as the operational risk. Okay? Got it, everyone? This concept should be very clear in your mind. Okay? A bank has some securities with rating A. The rating migrates to BB. The bank has been exposed to which type of risk? Now look at this. What is this? Rating is A. Now it has gone down to BB. See here, A is always a good rating. A and BB is below A. Okay. So now from A it has gone to BB. So it is minus, negative side. So what is this risk? Market risk, credit risk, market liquidation risk, or operational risk. What is it called as? It is called as, everyone? It is called as, yes, it is credit risk, because the rating has gone down. Whenever the rating goes down, it means you are facing the credit risk. Remember this. Okay? Clear? What is the Macaulay duration of a bond with the remaining maturity of 5 years if its yield is 6% and its modified duration is 5 years? What is this, man? Think over it, everyone. Firstly, what do you want? You want Macaulay duration. What is the relationship and what is given to you? Modified duration is given to you. Modified, given. See here. So I'll write it over here. Modified, I'll just write mod equals to given. What is given? 5 years. No, modified should be in, yield is 6% and its modified duration is 5 years. It should not be years. Modified duration is always in percent. So modified duration is given in 5%. Okay. Now you want Macaulay duration, MAC. I'll just write MAC now. MAC is a question mark. What is a MAC now? What is the relationship between MAC and mod? Yes. JIB. Again JIB. So mod equals to MAC upon 1 plus R. Okay. Mod equals to MAC upon 1 plus R. Modified duration equals to Macaulay duration upon 1 plus R. So what all do you know now? Modified duration, do you know? Yes, 5%. So I'll write here 5%. R, do you know? Yes, R is given. What is given? 6%. So that is also known. So now find out what's the difficult part now. So I'll write it over here now. So MAC equals to, I'll mark it like this. MAC equals to mod into what is 1 plus R? 1.06, right? Directly I write it 1.06. So 5 into 1.06. So what is the answer now? 5 into 1.06. Everyone calculate. Yeah, 5 into 1.06. So the answer is 5.3. And this is in years. Always remember, Macaulay duration is in years. Modified duration is in percentage. Okay? Remember this by heart. Got it, everyone? Clear the concept? See, this concept clearance is an important part in your CAIIB. Okay? Learning is not that important. Got it? Because concept clarity is a must.